Hello, everyone. Welcome to today's webinar. We're going to be talking about the QBI deduction, which is a nice perk for us small business owners, and how court reporters can make sure that they're taking advantage of this, learn a little bit about what it is, and then also get a kind of a rough estimate of what this deduction is going to be for you. If you're a newer court reporter, it might be helpful to help with your overall numbers as far as what taxes are going to look like. Make sure you can kind of get all those different line items that you're going to benefit from to reduce your tax bill. And if you've been a court reporter that's been around for a while, maybe you've heard this term in the past, but you weren't sure what it actually was or how it was calculated on your tax return. So hopefully this can just fill the gap and be a nice educational piece to round out your tax knowledge. So let me share my screen and we'll get started into today's presentation. All right. What is the QBI deduction? So it's qualified business income deduction. And basically it was created with the Tax Cut Jobs Act in 2018 as a benefit for small business owners. One of the rules is that you have to be a pass-through entity. And basically what that means is that your taxes for your business get listed on your personal taxes, and you can't put money into a business account to avoid taxes for this year. Anything that you make this year and you earn as income, you're going to pay taxes on this year as well. So this is like a sole proprietorship or an S Corp, basically any of the business structures that a court reporter would have. For the most part, what wouldn't count would be a C Corp, which I wouldn't recommend anyways. But if you are a C corporation, you wouldn't get this benefit or this deduction. And what it is, it's a 20% deduction on that qualified business income. So remember, a deduction means that it's subtracting off of what you earned. So if you earned $100,000, then you get a $20,000 deduction. So then now, according to the government, you made $80,000. So that's different versus a credit, where a credit could be like you owe $10,000 for taxes this year. And if you have a $2,000 credit, you get $2,000 off of your tax bill. So we're talking about a deduction here that you can benefit from. So court reporters qualify if they're receiving 1099 income, not W-2. So if you're an official, this probably isn't going to benefit you much, maybe just a little bit of benefit off of your transcript income, but that's about it. If you're operating as a sole proprietor or LLC or an S Corp, then you are going to benefit from this. S Corp, the tax is a little bit different, or the deduction's a little bit different. So we'll talk about that today as well. All right, if you want to get this benefit, the only really main thing that you need to worry about is going to be the income thresholds to receive this deduction. So not everyone can get this deduction. There are phase outs like there is for most tax benefits. So if you are a single filer, you need to be earning under $191,000 to get the full 20% deduction off of your taxes. If you're married, then it goes up to $383,000, which is a pretty high mark to be able to get the full deduction. So that's a really good benefit for most of you. Then there is an upper limit. So there's like a phase out period where maybe you don't get the full 20% deduction, but you still get something. And that goes from this 191 to 241, or if you're married, 383 up to 483. So if you end up somewhere in that range, you're going to get some benefit, but not all of it. And then if you're over these numbers here on the bottom, then you're not going to get any deduction at all. Good news though, like I mentioned, most court reporters that I see usually end up below these thresholds and they're able to take advantage of the full deduction. Moving on from there, to calculate what your QBI deduction is going to be, there's 3 easy steps to do that. Number 1 is you need to know what your business income is. And then once you have that business income, then you're going to need to subtract out what your expenses are, your health insurance that you pay for if you're deducting that from your business, and also your retirement contributions as well. So all those need to be removed. And then what's left over, that's what you get to take that 20% of to get the deduction and get the benefit. So again, you got to keep in mind comparing that to what the limit is on whether or not you're going to be able to get this deduction and this benefit. But just an example, and this is income that's well below those thresholds I mentioned, just to keep it nice and easy. If you had a 1099 income for your business, $100,000, and you got to subtract out business expenses, then the health insurance premiums that you pay for, and then your SEP IRA contributions, which let's just say was 12,000 for the year. After all this, you're left over with 60 grand. So then this 60,000 number is what you do 20% of, and then that's going to be a $12,000 deduction that you get off of your taxes. Now, the main reason that you're subtracting these things out is because you're already getting a benefit. You're already getting a deduction. So it doesn't make sense for them to give you 20% of a deduction as another deduction on top of that, right? So we got to subtract some of the perks that you're already getting as a business owner, such as the ability to write off business expenses, the ability to write off health insurance, which is a big one you want to make sure you take advantage of, and then also contributing to retirement accounts that is a tax deduction as well. So basically, you already get to subtract all these and get you down to 60,000. And then now we just get another 12,000 that we get to subtract on top of that. So that actually brings your taxable income now all the way down to 48,000 is what's left over from that $100,000 starting mark. So good news is there's lots of perks here to be able to get your income down as a court reporter. It's really just about making sure that you're taking advantage of all of them. Now, some mistakes that you want to avoid is when you're doing the calculation, right? Your qualified business income, some of the positives is that your self-employment taxes, your standard deduction, your personal expenses, you don't have to subtract those out before you do the calculation. You get to keep those in there as part of the calculation. But you do have to remove those other things I mentioned, the business expenses, the health insurance premiums, and the retirement contributions. What doesn't count as QBI as well, and we'll get into this a little bit more in a second, is W-2 wages, like I mentioned. Also, investment income. So if you're getting like dividends from your investments, any capital gains that you receive, or any type of business partnerships, or basically anything else out there outside of your traditional 1099 earned income is not going to count towards this. So we want to make sure we're just being consistent here and following the rules to get down to what number we're actually multiplying by 20% to get that deduction and that benefit. So if you're a high income reporter, some of the things you may need to be looking out for here is how do I get below that income threshold in order to contribute to, or not contribute, but in order to get my QBI deduction, right? How do I maximize this? So one of the ways is to contribute to your retirement accounts to lower down that income, right? You have to get that QBI number down below the threshold. So if you're just above it, maybe doing another $10,000 or $20,000 toward retirement accounts for the year will push you below that threshold and give you a bigger benefit or get you that full 20%. Also, if you are going to consistently be going over that threshold every year, you can look at bunching your deductions. I've talked about this in other webinars where you can do things like taking your property tax deduction twice this year, or like business deductions. Maybe you're buying like a bunch of equipment this year, trying to prepay for conferences, right? Try and bunch up our deductions as much as we can to get you below the threshold. Maybe this year you get to maximize the QBI deduction because of all those things you wrote off. Next year you won't be able to, but then the following year you go take a lot of deductions again. So you can do a back and forth strategy where you're every other year getting to take advantage of these types of benefits. And then lastly is harvesting any investment losses. So again, people talk about right now is like tax loss harvesting and how you can take advantage of that. So if you can tax loss harvest, you can get another $3,000 off of your income. Again, not a huge amount, but maybe this is what puts you below that threshold again to be able to get the full 20%. So lastly is going to be the impact of filing as an S Corp. And this is a pretty big deal here because when we talk about S Corps, we talk about a lot of the perks and the benefits of an S Corp and the tax savings. This is one of the downsides of being an S Corp actually, is that you lose out on some of the QBI deduction. So starting on the left, if you're a sole proprietor, it's very easy, right? Let's say your QBI is $100,000 for the year, then 20% is going to be $20,000. And so you get to take that full deduction. Separately, if you're an S Corp, I mentioned that being a W-2 employee means that for officials, they don't get a benefit here, but it also works the same if you are an S Corp and you're paying yourself a salary as well. So if you make 100,000 of QBI, let's say, but then 40,000 of that is salary and 60,000 is distribution, you only get to take 20% off of the distribution amount, not the salary amount. So now your QBI is adjusted down to 60 grand and you're going to get the deduction of 12,000. So you're getting $8,000 less deduction in this example from being a sole proprietor versus being an S Corp. So it is the pros and cons to think about of losing out on that QBI. I will say, and I have it listed down here at the bottom, typically the S Corp still wins out when we compare all these different metrics and line them all up and see which one's better and which one gives you the most tax benefits. It is still the S Corp most of the time here, especially I always mention the rule of thumb of 100,000 after business expenses. So if you're making 100,000 after all the business expenses, then an S Corp is most likely going to be the best option for you. So that's everything in regards to the QBI deduction. Again, it's a really nice perk that you get on top of writing off your business expenses and your health insurance and retirement benefits. And it really isn't just a nice perk of being a small business owner and getting this extra line item and deduction on your taxes. So let me know if you have any questions on the QBI deduction in the comments, and I'll make sure to get those answered. Otherwise, have a great rest of your week, and I'll see you all next time.